Welcome to Joint Session, Diverse Voices in New York State Cannabis. I'm Herb Barbot, former and first Director of Operations at the New York State Office of Cannabis Management. This podcast brings together policymakers, regulators, licensees, advocates, and industry leaders to talk through the realities of building a cannabis market in New York and what those lessons might mean beyond the state. In Season 3, we continue the conversation while we celebrate the 5th anniversary of the Marijuana Regulation and Taxation Act. We look at how policy translates into practice and how practice may impact policy. Through it all, businesses must navigate change, all while trying to prepare for where the industry may be headed next. We aim to bring you thoughtful, candid discussions about what's working, what's evolving, and what still needs to be figured out. Thanks for joining us, and now here's the episode. My guests today are Daniel Sabat from Green Growth CPAs and Alex Norman, co-owner of Bodega, a New York licensed cannabis dispensary based in Park Slope, Brooklyn. Today, we're diving into one of the most complex and consequential issues facing cannabis operators. That's tax planning under the Internal Revenue Code, Section 280E. Welcome, Daniel and Alex.
Hi, how are you?
Yeah, thank you for having me. Good to be here.
It's a pleasure. Thank you for both for taking the time today. So, Daniel, let's start with the basics. What is 280E and how does it impact cannabis operators?
So 280E, it's an IRS code that's been around since the 1980s.
Mm-hmm.
And in a nutshell, what it's saying is that if you are trafficking a Schedule 1 drug, which cannabis still currently is a Schedule 1 drug. I know there's talks about it being rescheduled to Schedule 3.
Mm-hmm.
But anything to do with the Schedule 1 drug, you cannot deduct anything other than your cost of goods sold. So no ordinary necessary expenses.
Mm-hmm.
So in a nutshell, what this means is, let's say you have a dispensary and you have $100,000 a month in sales, and the cost of the products to produce those sales is, let's call it 50%.
Mm-hmm.
So now you're left with $50,000. All those other costs, like your rent, your utilities, your POS software, the office supplies, the labor, are not considered cost of goods sold if you're looking at letter of law. So now let's say that number goes down to $10,000.
Mm-hmm.
You're still going to get taxed on the $50,000 because that's your true cost of goods sold. That's everything in a nutshell. But obviously there's some gray areas there.
Right, and that's regardless of whether you're a licensed, state licensed entity, correct?
Correct.
So, Alex, as a licensed dispensary owner in New York, how has 280E affected your day-to-day financial planning? And was the reality of it different from what you expected when you first entered the market?
Yeah, I mean, I guess people don't really start thinking about their federal taxes until the first of the year, because everyone has to file by April or March, depending on what your corporate structure is or your business structure is. Yeah, I mean, we were well aware of it. Again, we weren't really paying much attention to what we were actually on the hook for. Obviously we have to pay our quarterly taxes to the state, which we've been on time with. We've paid in full. We're not in arrears. It hasn't put us out like some other operators, as it's done to some other operators that maybe took their eye off the ball. But yeah, when we did speak to our CPAs, they did, remind us, that we were, on the hook, for, in our case, $60,000 in federal taxes, based on our gross revenue. Like, Daniel explained, it was definitely a kick in the gut, considering that, I think my partner and I have been running a pretty, I don't want to say the leanest operation, because we are putting a lot of investment into our brand and into a lot of our content marketing. So we're aware that we're coming in a little bit hot on that end. But for the most part, we're very mindful of our payroll and just our daily expenses, weekly, we kind of talk about it twice a week, for sure, just so we don't take our eye off of it. But yeah, I mean, that's where we stand right now. We did put in for an extension, in lieu of, potential rescheduling this year. We were hoping it would happen before we filed, but Having spoken to a couple of other operators, they had said they were putting in the extension just to see what happens, and we get to, basically, punt or kick the can down the road until October. So I know there's a meeting in June with the DEA regarding recreational cannabis. Hopefully, that process, speeds things up in our favor. So we'll see. We'll see.
So, Daniel, is there a business structure, whether it's an LLC, an S corp, a C corp, or other, that offers any tax advantage for cannabis operators operating in New York? And does the answer depend on the type of license that you have, what dispensary, cultivator, processor?
So as far as the best taxable structure, I always recommend a C corp, whether you're a dispensary, cultivator, or manufacturer. Now, sometimes when there's multiple investors, the C corp can be a little complicated, especially when you have outside investors and you're doing fundraising.
And what's
So
the
that's
advantage to the C corp?
So there's several things there. Number one, there's peace of mind there. You have the best protection against, against the IRS. If anything was to happen, if let's say the business goes belly up and you're stuck with a big tax bill for whatever reason, the IRS can't come after any of the owner's personal assets. Whereas any flow-through entity, whether it's an LLC, an S corp, or just general partnership, they potentially can, and that's a big one because I've had so many operators in different states who, they thought they're going to be profitable, and then there's some disputes. The cost per pound, the cost for flower goes down. Their marketing situation wasn't what they expected, and all of a sudden their sales have dropped and they're potentially going out of business. At least in this case, whatever they've done before the operation started, owning a home, owning stocks, whatever assets they've had are fully protected if it's a C corp. So that's number one. I'd say people have a misconception that C corps have a double taxation and you're getting taxed 2 times versus 1 time. But ever since the Tax Cuts and Jobs Act, C corp is only taxed at 21% on the federal side, and then the second tax, which is the dividend tax, that could be anywhere from 15 to 20%. Usually it's 15%, depending on your tax bracket. If you issue it as a qualified dividend, which once you own the stock for more than 4 months, you can certainly do the qualified dividend. So when you add those 2 taxes together, it's pretty much the same as the one-time ordinary tax. Obviously everyone's tax bracket is different, but it's like plus or minus 2% usually. So it's a very immaterial difference there. I think with the ease of tax filings, we talk about filing taxes and potentially going back and amending them depending on what happens with the rescheduling. Having a flow-through entity, it becomes more complicated because you have to amend those returns, and then you have to also amend the personal returns of everyone. And if you're doing that for multiple years, it can cause a lot of complications. Whereas with the C corp, it's just it has its own tax filing, so you just amend that and you're good to go. It doesn't affect anybody else. I'd say the biggest advantage though for the C corp is the 1202 small business stock exemption. And what this is it's a special exemption of capital gains. Whereas if you were to keep the company for 5 years and sell it, there's a huge capital gain exclusion where you can pretty much get it all tax-free as long as it's a stock sale, meaning you sell the company, not the assets underneath it. During the Big Beautiful Bill, it got improved even more. It used to be a $10 million exemption after 5 years. It's now a $15 million exemption. And there's some rules where if you want to sell it after the 3rd year or the 4th year, you still get a pretty decent deduction. You get like maybe 50 or 75% of your total capital gain wiped away. So a lot of advantages there.
And Alex, what structure did you and your partner choose in establishing the dispensary?
So when I first created Bodega, I created it as an S corp, but then we converted it quickly to a C corp. Based on our CPA recommendations, basically the same, for the same reason Daniel explained to us, and so it totally made sense. It was pretty straightforward. So that's where we're gonna be going forward for the foreseeable future as a C corp. So I was able to convert the company from the S corp to the C corp.
So Daniel, what expenses can cannabis businesses legitimately deduct under 280, and sort of say, compare like Bodega dispensary to Bodega the liquor store?
So the way it works is this: you have to use different 280E mitigation methods to get the additional deductions.
Okay.
But assuming we don't do any of that stuff, and you don't have a CPA who's on top of it and creative with these things, uh, in a dispensary, the only thing you can deduct are the actual product costs and the packaging costs behind it. Everything else, which would be the bud tender labor, the manager, the assistant manager labor, the dues and subscriptions, so like the POS software, the advertising, merchant processing fees, bank fees, utilities, travel costs, any of that stuff.
Interest on debt.
Interest on debt, yeah. Which is, a lot of people have, there's a ton of that, especially when you do a startup. Those are all technically non-deductible under 280.
And Alex, I mean, you seem to really be on top of this for a licensee. I mean, do you feel that other licensees are as aware of how to mitigate their tax liability?
I don't think they are, because I do have a background in financial planning.
Okay.
I don't know if it's made me any better off than anybody else. To be honest, then I don't know. It's like the Matrix. It's the green or the red pill. Which one do you want to take? Because what difference is it going to make? Being aware of it, sure. It's I get to kind of just geek out a little bit and go back into my tax planning experience, having been a financial planner in a different lifetime. But other than that, it just doesn't. It's I just keep on top of it, but I don't think it's really made much of a difference. Other than maybe helping out other licensees to kind of just look out and be aware and pay attention to certain things, and then just kind of redirect them to the proper CPA to kind of really keep them up to date with tax laws, because the one thing I do remember is that when I was a financial advisor, tax laws change all the time, so you have to kind of really just be abreast of the changes, so that you can make the right strategic moves. But honestly, other than that, it really hasn't, like I was saying earlier, my partner and I keep track of all our bills, all our expenses, our cash flow, things like that. But it because we can't do any of those deductions, it hasn't really affected our strategy in saying, well, we can deduct more of our marketing expenses. Let's get a little bit more aggressive with our marketing and our merchant brand strategy, because we have a strong brand, and we also benefit from getting more deductions, so we could be a little bit more aggressive. We don't really get that. So from that standpoint, it doesn't really play into that those decisions. We just know we can't get those deductions.
So Daniel, how can cannabis businesses separate their plant touching operations from any ancillary services or activities in sort of an effort to maximize their tax deductions?
I would say the only one that I've seen that works effectively, and it's not so much with dispensaries, it's with cultivators and manufacturers, is to create a separate IP company, which the idea behind that is that this IP company would provide the SOPs, the methodology, the know-how on how to grow, on how to cultivate, how to manufacture, and they'll take on a lot of those non-deductible costs, such as commissions, HR, to an extent, accounting, and then in return they'll charge a royalty based on a separate equation, based on a percentage of sales. Typically, we see that anywhere from 8% to 13%. And ideally, that's the idea there, is that those costs that they absorb and that royalty that they charge would offset each other, where that IP company would make little to no money, but the royalty that they're charging would be a deductible cost of goods sold for that operation. Other than that, as far as separate entities like management companies, or those are not a source of 280E deductibility. Those are more for people not wanting to being associated with cannabis. Some states have rules. I know Oklahoma had a rule where if you're not an Oklahoma resident, you can't own a certain percentage. So they'd make those management companies to shore up the economics. Same with when there's like a social equity partner who owns 51%. A lot of these states, people who partner up with them, they'll make a management company where maybe they own only 20%, 25%, because obviously they're bringing a lot more to the table. But yeah, as far as separate entities, I think the IP is the only one I've seen that's worked effectively and been proven to work in court. However, there are some within the same entity 280E mitigation strategies that we can talk about, as this podcast goes on.
So, Alex, is this a strategy that you've either employed or are thinking of employing, and what's the sort of thought that you're having?
Yeah, I mean, the only thing that we have going on for our, our next move that, our CPAs, felt it was a good idea was, as you know, Herb, they're opening up our cafe. And so that's something that we know we could potentially push off a lot of those expenses to the cafe to get those deductions on that side. But, those, I guess, if we're set up as an S Corp, and then please correct me if I'm wrong, we could then potentially pass off the cafe expenses to our own, personal returns in the form of losses to reduce our overall tax liability as one idea. But, because I think, Herb, you've seen our space. We subdivided the space. The 3rd Street entrance to our store has its own address, and the entrance to our dispensary has another address for 4th Avenue. So that allows us to, create that separate entity that we can, utilize to say, hey, the dispensary isn't going to pay, $12,000 a month in rent anymore. We're going to push $8,000 to the cafe, because we don't get a benefit for the dispensary being, $12,000 a month in rent, because we don't get to write that off. So something like that, is what we're looking at in terms of like our next, strategic move that can work, for us from a tax perspective.
And Daniel, how does that sound?
Well, in theory, that could work. They would want to see, for example, what the market rate of rent would be for a cafe of that size, right? Like if the whole space, let's say, is 3,000 square feet, and the cafe takes up 1/3 of that, it wouldn't make sense to push 8,000 of the 12 there. Maybe 1/3 of it, or there could be some justification of one of them is on the front versus the back. It's more premium spot, but you can't push the envelope too much on that, just because it has to make economic sense in the eyes of an IRS agent. But like I was mentioning, and I guess we can get into this pretty soon, there's several 280 mitigation methods that we use, which you can get a lot of those deductions regardless, especially with the way tax laws have changed over the last few years. I've been with Green Growth CPAs for over 6 years, and in the beginning we used one method, and then we got more comfortable using another method once we spoke to attorneys and got some guidance and saw some results. As they've gone through audits that resulted in no change audits. So those strategies that we can get into pretty soon, I could dissect and kind of go over what we did and what the potential tax savings was.
Well, just jump in and go ahead. I mean, I was going to ask about payroll tax strategies. If there's sort of anything that cannabis businesses should consider when compensating the owners, executives, employees that that would be helpful in this context.
Yeah, absolutely. So here I can give you guys like a whole summary of everything that's transpired over the last 6 years in my experience. So the original 280 mitigation strategy was called 471A. That's for 471A-3 for dispensaries and -11 for manufacturers and cultivators. And basically what's happening here is if you do accrual accounting and you treat a lot of those expenses as inventoriable costs, you can deduct portions of each of them, where you take a portion of them, put them into cost of goods sold, and then the remainder will sit in expenses as non-deductible. And the different strategies are, we usually get a site map of the entity, and we dissect every area. In a dispensary, the inventory intake area, the storage, the part, we make a formula, an algorithmic formula for non-THC products. And after we document all that stuff, we might get 50 to 60% of the square footage would be deductible. So now what that means is that if your rent is 10,000, 6,000 of it we can justify as cost of goods sold. The other 4,000 would be in non-deductible expense. And then we can use that formula for a bunch of other line items, such as POS software, utilities, rent, like we said, and there's like a whole laundry list of other things that will fall into the square footage method. And then for labor, we would look at each position and determine how much time is spent actually on the sales floor versus doing ordering, packaging, inventory management. And the bud tenders have the most time on the sales floor. It's hard to argue that. Right. From our experience, we take probably about 25% of their time as deductible. The other 75 would be sales activity non-deductible. But the assistant managers or the shift leads and then the managers, there's more leeway there. We usually get 50 to 60% on the assistant managers deductible, and then 75 to 80% on the managers. And then there's a bunch of other activity-based methods for accounting, legal costs, supplies, things like that, that we can maybe get 50% on. So all in all, you're getting a pretty decent savings here. We're doing that for a while. That's the safest method. It's always worked, in any audit we've ever gone through, and any audits that our lawyers have gone through. There was another method that we've implemented 3 years ago, and we've pushed all of our dispensaries into doing that. And they've been very thankful, because it's saved them an additional, I'd say 35 to 40% on their tax bill, which is huge. And that's 471C. And what 471C says, this is something that came out during the Tax Cuts and Jobs Act. It was kind of hidden in the literature. And we weren't sure if it was going to work, so we didn't really push the envelope on it in the beginning. But what it says is that if you have 25 million or less in gross receipts, I believe now it's 30 million, it's adjusted for inflation over the last 5 years, you can theoretically create your own modified form of accounting, meaning it's not IFRS, it's not GAAP, it's like your make-believe, this is how I'm doing my accounting, and you could determine what your cost of goods sold are. So you have your own definition of it now. And black and white, that means you can pretty much throw everything in there, right? It's like your bank fees, your advertising costs, everything. But after speaking to a couple different attorneys and getting their opinions and methods of how they've gone about it, we took a big chunk of stuff directly into cost of goods sold. There were 4 or 5 line items that we just couldn't deduct. We're just going to leave them in expenses and take the hit. And then there's another 4 or 5 that we would take portions of it, just like we would under 471A. But then the remaining amount, we wouldn't take it as non-deductible. We'd actually push it into what's called an amortized asset in the balance sheet and take portions of it every year. And then ideally, when the rescheduling happens down the road, whatever's left, we can take an accelerated amortization. So I'll give you an example. The parts that we wouldn't deduct would be the bank fees, the advertising, the entertainment, the interest expense only on non-inventory items. So if you have terms with vendors that's gonna cost you some sort of interest cost, that would be deductible. And just if you got like a third-party loan, it wouldn't be. And charitable contributions wouldn't be deductible. Then on the parts that are amortized that we'd push over for 15 years, it would be the bud tender pay and the bud tender payroll tax, the rent, the utilities, and the interest on inventory items. So just like my example before with the bud tenders, we take 25% deductible, but the other 75% we'll still get it. We'll get it down the road. It'll be a temporary timing difference. We'll go into the balance sheet. You take 1/15 of it every year, but then let's say by next year rescheduling is confirmed. Whatever's there, we just accelerate that year to take it in full.
So Alex, does this sound familiar?
Yeah, I mean, we when we spoke to our CPAs, they had said, very similar, offered a very similar strategy in terms of like carving out a certain side of the store that would have non-cannabis products. And it would just be like dedicated to just like one side of our entire store is dedicated to just retail. So we don't have any cannabis products on that side of the store. And so and they had mentioned the what was that again, Dan? It was a 471. Um,
Right. So there's two of
yeah,
them, 471A and
yeah.
471C.
Yeah, so they had alluded to that early on when we were first opening up, how to just kind of set ourselves up. And then they had mentioned that if we had one bud tender on one side of the store where all the retail products were, that you could potentially treat that person as you could partially deduct some of their salary because they would handle all the retail non-cannabis transactions and products and stuff like that. So then, because that side of the store, and actually like a good part, I want to say maybe like I want to not 40%, but like 30% of the store, there's non-cannabis products there. There's a opportunity to deduct that portion, I guess in the form of square footage, right? To the space as a deduction, from I guess our gross revenue. Um, to put it just in simple terms, I definitely can't repeat what Dan said, but I totally understand it because I heard our
No,
CPAs tell us the same
and
thing. But I think to Dan's point though, what's important for operators is that key component, like start setting yourself up, before you open, how to proceed forward to try to maximize, those tax benefits. Because if you don't have that in place in the beginning, and then you're trying to figure that out and you haven't really set it up, set up the play to run it, and then you're trying to change up the play in the middle of the game, and then you're trying to catch up and make adjustment, it becomes very like more convoluted and harder to kind of fix midway through.
no, and you guys do have some great merch in the store, and I was wondering why so much space was taken up with the merchandise. Now I get it.
Yeah, and we have a new merch drop too coming for our 1 year anniversary. Like, we completely flipped all the merch on its head, and we have a bunch of collaborations that we're doing with other brands. So we're super excited about that. So next week, if you decide to pop in, Herb, you'll see we're gonna have a whole new lineup of merch items that I'm very excited about. I got a preview of it yesterday because Lewis, that's his wheelhouse. So he's been cooking some really exciting new merch for the brand, and then going forward we're gonna have some collaborations going on as well. So we're excited about that.
Can't wait to see it.
Just so you know, on the deductibility on the merch, it's not apples to apples. Where it's
Yeah.
like, because obviously, a T-shirt takes up a lot more space than a jar of weed, and it's just like, if your sales are 95% cannabis and 5% merch, but the merch takes up so much more room, there's an algorithm to like how we would factor that into the square footage, but it does help a little bit for sure.
So,
Yeah.
Daniel, what are the most common 280E related mistakes that cannabis businesses make?
Well, the number one is just not using the right mitigation strategy. I feel people have a fear that they're going to get audited, and then they're going to look at all their costs and just uh, add them all back with penalties and negligent penalties and all that stuff. And I mean, rightfully so. It's some people are risk averse and they don't want to do that. And to be honest, when we first started, we took a more conservative approach. But as we saw, for us, we believe 471C is the best way to go. So Alex, just to touch on this a little more, a lot of those things you're talking about with bud tenders and this side of the store versus that side of the store, you just got to make a reasonable basis on that. But then with 471C, you'll still get those deductions even on the other side over time. And a lot of the other costs that we have associated with cannabis, the POS software, the dues and subscriptions, the legal costs, the accounting costs, whole laundry list of items, we could actually take them in full under 471C In fact, even the manager pay and the assistant manager pay is fully deductible under 471C. It's just the bud tender that we would split out a little bit. But even with that split out, you're getting the intangible asset amortization down the road. So a lot has changed. A lot of these strategies from the past, they're not, what's the word? They're extinct. They don't exist anymore. There's new ways to go about it.
So, given that cannabis businesses often operate, in cash, what are the tax reporting and compliance risks that come with that? And how should operators protect themselves?
So there's a couple aspects here. One is just internally, you want to make sure you have all your cash, right? Trust but verify. You might have some employees who are tempted to skim money off the top, right? And having good cash controls in place is very key. When we work with clients, we provide them with really helpful templates, a cash log template that has all the ins and outs with Excel formulas attached, and then cash count sheets that they can do a cash count in the vaults, however often they want. I would recommend doing it at least once a week, but some people want to do it every day, and that's fine. And having some sort of dual control where when they count the cash, there's another employee present. So that way, there's a less chance of one person just, sneakily taking money. Now there'll be two people involved. One person can push back on it. And always closing out the day with, looking at the POS versus cash on hand and just making sure that they match. And they'll probably be off by a few dollars here and there. That's just common in cash business, but you don't want it to be off by hundreds, thousands, tens of thousands of dollars over the course of time, which a lot of my clients that I just started with, they have those discrepancies and they're not sure why. So that's why they didn't have those controls in place. As far as collecting cash, I guess for dispensaries, it's not as common. There's the 8300 forms, right? That I guess they're gonna want them to fill out for the cultivators and the manufacturers. For actual dispensaries, their sales are not going to be $10,000 in a given transaction. It's that would be a non-issue for them.
Yeah, Alex, I don't know if you're interested in talking about the process at Bodega for handling.
Yeah, I mean, what we try to do is start with the same cash count, every morning, and then we oversee when there's a shift change to make sure when they count their bills to close out their register, it's as close to zero as possible. Sometimes it's a little over, sometimes a little down, sometimes it's off because someone, and this is what, and it takes the work because you have to do the work. Someone may be, inputted the transaction wrong instead of having put it under cash, because you have an option to put in cash, debit, or AeroPay. And I've done it myself where I just brain fart, I hit cash, but it was AeroPay because the button was right below, and then I'm like, how am I off exactly $100? And then my partner and I are like, all right, let's take a look, and we have to go through all the transactions to make sure nothing got lost there. So that's what we do. If it's again, if it's off, you have to go through the steps of just kind of looking at all the transactions. It's something that you just have to stay on top of. But I think to Dan's point, I think just, every day we start with the same cash count. We close out the registers. One of the managers is there always to close out the registers with, on the shift change, and then count their money when they count out. And then if it's off, we just kind of have to take a look, at all the transactions, because we've never had an issue where it's we couldn't account for the missing $20 or $40. And then sometimes we're up, we're like, how am I up $60? How did that happen? So we still have to look into that, because we might have double charged the customer by accident, because they already prepaid. Then the bud tender again just kind of spaced out, and told them to ring up again the AeroPay, and then again the customer doesn't know, or it's just, so things like that happen. But we haven't had really any major issues. And I mean, we don't have tons of cash again because everybody just does debit cards. And so, I mean, we do deposit money, but we have like a smart safe. And so as soon as we don't really leave a lot of cash sitting around, other than the change that we make once a week for, singles and fives, quarters and dimes for the register. Um, so it's not like big amounts of money just laying around. We kind of just reconcile, based on what Dan said, what's going on at the POS, how much cash we deposited, and then just take it from there. So we definitely haven't had any issues like that. So but again, it's just, you got to just stay on top of it. I tell people, like, the running a store isn't really hard. It's not like rocket science, but you just have to have your processes, set up so that they just have to be repeatable, where you just constantly, staying on top of things, because things can unravel really quickly if you just kind of take your eye off of it for 2 days. You know what I mean? Because it turn into like a mess, the minute you let your guard down a little bit. Yeah.
And I was gonna bring up the smart safe idea, but I'm happy to know you already use it.
Yeah.
That saves a lot on the controls, because
Yeah.
effectively the smart safe, once you put the money in there, you get credit in your bank that you can start sending wires, ACHs, write checks,
Yeah.
and then they'll just come pick up the safe every 2 or 3 weeks.
Yeah, we're trying to get them to come every 2 weeks now, because they like to just come every week, no matter how much money's in there. And, when we look at our bank statements, we always, because we're always paying attention to our costs. We're like, wait a second, why are we paying $600 a month for banking? We complain to Dime. They're like, well, we only charge you $200. And then it's like, well, it's all these pickups. And I'm like, yeah, I'm there when the guy takes out the cash. It's like the thing is half full. Like, you didn't have to come. Same thing with our ATM. We have to tell Brink, stop coming every week. You're not even filling the thing up. You guys are just running up a bill on us. And so, that's part of running the business. Those things add up. At the end of the year, you could easily spend $20,000 by the end of the year on all these silly services that you could cut back on. Because you just think you're supposed to do that.
So Daniel, how should cannabis businesses, dispensary owners like Alex, be planning now for the tax implications of a potential shift, whether it's reschedule or descheduling of cannabis?
So I've talked to a lot of my clients about this, and the recommendation is for the 2025 tax year, a lot of people are on extension, is to continue using the 471C method. And the reason why is because let's say that they come out and say that, they have that meeting in June, Alex, and they say that recreational cannabis is going to be rescheduled to Schedule 3. Effective date is January 1st, 2026.
27.
So now we have they can go retroactively back if they
Okay.
wanted to as well.
Yeah.
So let's say they do that. Then for the 2026 tax year, which we filed the following year, now we have a basis to say, okay, this is the year that we're gonna deduct all costs. And then with 471C, all those stuff that was sitting in the intangible asset, we'll also deduct those as well, things that have been lingering for the last couple of years. So now they'll have a huge tax, like a one-time tax advantage that 1 year, and then going forward it'll just be like a regular business. I think that's probably the most conservative, and at the same time being conservative, you're still getting most of those deductions that you would have gotten just retroactively going back. Now, obviously, things can change. In June, they might say recreational cannabis has been rescheduled, and you can even go back as far as 2023, in which case you're going to have a lot of people go back and amend the returns and try to claim those refunds. Personally, I don't think that's going to happen, but you never know.
So
Yeah.
if 280E were eliminated tomorrow, so what would that mean for your business financially, and are you already positioning yourself, for that scenario?
Oh, I mean, according to Daniel, I would still be on the hook potentially for, that $60,000, which we have set aside. I don't know, Dan, I'm going to punt it to you. I still want to try to file for, put in for my deductions and see what the IRS says. Couldn't they just potentially reject it? There have been cases where some MSOs out in the Midwest have filed amended returns and have actually gotten money back, right?
And just basically ignore the 280E.
Or I don't know if they'd even realize that they were giving these cannabis businesses. I don't know. Is it possible they were just like, okay, it's just a pile of paperwork and They really didn't do the extra step to just take a look at what kind of businesses these companies were. Um, or do we? Because for me, I don't. Again, I know that the IRS is at 50% capacity. I know audits are down. There's a 3-year statute of limitation, on audits. Are they gonna really pay? And then what's the worst case scenario if they reject my deductions, right?
Yeah. So I could touch on this too because I've had this
Yeah.
situation come up. Uh, so there are some bigger operators that I've talked to who are taking even now the 280E does not apply to me approach, and some of the arguments are that it's unconstitutional, that there's some tax court guidance on why this shouldn't be the case, saying that the item it's THCA until you actually light it. So you're selling hemp, and then once you light it, it becomes cannabis. There's all these different arguments. However, even the attorneys that I spoke to who are writing this very expensive memo for these clients, they even said that if they get audited, it's not going to work. But because they took a reasonable basis, they won't get charged penalties for taking this basis. So it's kind of like a risk reward thing. You can determine what your percentage of chance of getting audited is. It could be 25% or 20% or whatever it is. Some of these bigger MSOs though that you mentioned, if they get audited and they lose, they're still going to fight it in tax court, and they're probably going to spend over $1 million doing that because the tax savings for them is in the tens of 15s of millions.
Yeah,
We're talking
we're not in that category, but yeah.
Yeah. Yeah, so that's what I'm saying. For operators who are in that 471C level, 25 million or less, you're better off doing 471C, getting 70% of those deductions, putting the rest of them into an intangible asset, and then next year you get the accelerated approach on that. Like it makes a lot more sense. But yeah, even going back though, amending prior returns versus just doing it this year even can really put you in a category where you're more likely to get audited than not. So that's why it's been recommended not to go back. Just do it going forward.
Yeah, and then wasn't there a case that New Mexico case? Didn't the IRS make a ruling that because everybody was like holding their breath on that case to see what the IRS said? I think the New Mexico operator. I think they were medical.
Court case in New Mexico, right?
Yeah. Yeah. And then the IRS just said no. You're wrong.
I believe that was the outcome, and I know that they recently said that the whole no taxes on tips that does not apply to bud tenders who may receive tips until something happens with rescheduling. So for now, any tips you get, you have to pay taxes on if you're a bud tender. So anyway, finally, just ask for cannabis operators in New York who are just getting licensed or are early in their businesses. From each of you, what's the single most important piece of tax planning advice that you'd offer them? So, Alex,
Oh, you want me to give other operators tax advice?
for both of you. I mean, you're living it.
Pay your taxes on time. I don't know.
Get a good CPA.
Yeah.
I would say understand what your taxable income is going to be ahead of time. Do very strong projections, and then reassess those projections in real time. So every few months, every quarter, kind of see where you're at, look at your numbers, because you have to pay estimated taxes based on that year's income. If you go through the first 3 months and you're $200,000 a month in sales, you'll have a sense of what you got to pay. And then, but let's say things speed up in quarter 2 and you doubled your sales, then you have to readjust those estimated tax payments.
Yeah.
The thing with estimated taxes, it's kind of tricky. You don't want to pay too much because then you have less cash flow. You don't want to pay too little because then you're going to get penalized. So you got to find that happy median where it's like you just pay a little bit too much to cover yourself. You don't get charged those extra penalties and interest, and you can continue to operate with the remaining cash flow that you have. Entity structure is really important. Obviously, we talked about that with having the C corp, especially for a retail store, and then just working with a CPA to go over benchmarks, key performance indicators, looking at EBITDA, net income, all those things can really help drive your business.
Alex, you want to add anything?
No, I mean, that's kind of the same thing that our accountants have, said to us, and, I'm in agreement. Um, you know, I'm just holding my breath to see what happens with rescheduling. Um, Either way, and to be honest, I mean, we just, we did file an extension to punt and see what happens to buy ourselves some time. But, my partner and I are under the impression, or that we're gonna have to pay the money. We just put it to the side. Who knows, what could happen. Even if it does reschedule, maybe we still file for deductions, and the IRS says, you know what, we're not gonna bother. Like we're not. They're already, we're not gonna start chasing down all these smaller dispensaries. It's already a foregone conclusion. Who knows? At that point, because again, the IRS is just so understaffed right now, and audits are so down that are they gonna bother? I don't know if that's if hope is the best way to go, but like I said, we're under the assumption that we're gonna eventually have to pay out that money, and hopefully it's only for 2025, and by the end of this year, this time next year would be it's a different conversation.
All right. So, Dan, where can people find out more about Green Growth CPAs and Alex about Bodega Dispensary?
I mean, we have plenty of collateral and brochures. You can check out our website, www.greengrowthcpas.com. Also, if you look at my personal LinkedIn, I'm doing consistent blogs and posts and videos about all these different tax strategies, just state of the market, things of that nature. So you can look me up on LinkedIn. And also, anyone who has questions, they could fill out an intake form on the website or reach out to me directly, and I'd be happy to do a consult with them, see what they have going on with their tax plan, see what things that we can do to potentially help them, and provide some sort of controller or outsourced CFO level service along with tax filings.
Alex.
You can find out about us by just going to, well, at least what we're selling online, to bodega.nyc. That's where we have our blog. And then also we have, our online store, to in terms of what products we carry at the store. And then our Instagram page is really where, we connect with our followers on the brand side. Just our thoughts about the industry, our thoughts about, lifestyle as it pertains to New York City. We're a New York City lifestyle brand. And just kind of, the things that we deal with on a day-to-day basis. I know, Herb, you've seen our Bodega Insiders. We're very forthcoming about, the things that we deal with on a day-to-day. But then we also, we do sit-downs with gentlemen like Herb as well. He came to our golf simulator, had a really good time. See that smile on his face? He came closer to the pin that day. He was excited. And yeah, I mean, we just try to stay connected as much as we can, to our community and our customers, and at the same time to our business. So, again, you can find us at Bodega NYC on Instagram, and at bodega.nyc on our website.
All right, terrific. Well, thank you, Daniel Sabat from Green Growth CPAs and Alex Norman, co-owner of Bodega Dispensary, for sharing your expertise and real-world experience with us today. Thank you.
All right, Eric. Thank you.
That's it for this episode of Joint Session, Diverse Voices in New York State Cannabis. If you enjoyed this episode, please leave a rating and review on your favorite podcast platform. It helps more listeners find the show. In addition, please share this episode with colleagues, advocates, and anyone interested in the state of cannabis in New York. Joint Session is produced by me, Herb Barbot, together with executive producer Robert Curtis from Simlev. You can follow Joint Session on Instagram at jointsession.pod, on Blue Sky at jointsessionpod.bsky.social, and on LinkedIn at Joint Session Podcast. If you have any comments, questions, or suggestions on topics, reach out to me at herb.jointsession@gmail.com. Until next time, this is Herb Barbot. Thank you for listening.